The best time to bash Tesla stock is when it's already down big for the year, alluding to there being something wrong with the company, and then leveraging the media to hit it from all angles with accusation noise such that no one really knows what's going on with the company. We've already seen this before, just a few years ago, when Tesla was in a much worse financial position than it is today, and short sellers were coming left and right at Elon Musk for anything that he did that they deemed inappropriate in order to scare investors and take down Tesla stock. During the 2-year period between 2017 and 2019, Tesla stock actually did nothing. It rose and then fell back down to its 2-year lows, just as we're seeing today, with new lows hitting prices not seen since 2020. While this is reminiscent of the 2017-2019 timeframe, even back then, the media was focused with a fine-tooth comb on every single tweet that Elon Musk would write and how that could affect Tesla's business or stock in some way or another. But in the end, Tesla executed on its plans revolving around bringing the Model 3 into high-volume production, and when investors finally realized what the company had accomplished, the stock shot through the roof, creating the mother of all short squeezes and blowing out short sellers from their positions. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Today, the dynamics haven't really disappeared. The bears haven't forgotten how they were caught flat-footed and embarrassed for their terrible calls, and now they're back for round 2. Enter notorious Tesla perma-bear Craig Irwin, who was just recently invited back on CNBC to give his advice and opinion on Tesla stock. This guru has been dead wrong about Tesla at every step of the way, predicting demise from day one. He would have kept you out of Tesla stock years ago. Even at the current depressed price, Tesla is still up about an order of magnitude from when Craig started spreading fear, uncertainty, and doubt about Tesla, and now he's back again for more.
There's a view that his involvement with Twitter may be having an impact on Tesla.
Yeah, no, I think you're dead on the money. Its valuation, I believe, is driven by hype. Twitter is a hype machine. Musk is very clearly stepping away from Tesla to Twitter. He's got a lot of things to fix over at Twitter. And that is pulling the hype off Tesla.
Wait, if Twitter is a hype machine and Tesla's valuation is driven by hype, then wouldn't that increase Tesla's value? Irwin seems to believe that Elon Musk is taking the so-called hype with him over to Twitter, which is very negative for Tesla, and that's why Craig is confident with his astounding $85 price target, about half of where Tesla is today, even after this big fall.
If there was no Twitter and no SpaceX, would you say the same thing or no?
I would say the same. I would say exactly the same thing. I think,
It sounds like Craig is already starting to contradict himself, calling Twitter a negative, but even if there was no Twitter in the picture, he'd be saying the exact same thing. So why bring it up at all if Twitter doesn't matter? We can answer this by looking at Craig's qualifications. He covers clean tech companies in biofuels, advanced lighting, and companies providing services that enable the utility of the future. But more accurately, he has a BS from the University of, it doesn't matter because this explains where Craig is coming from. See, Twitter is a perfect scapegoat for the stock price decline at Tesla. Craig even mentions it by emphasizing that there are a lot of problems to fix at Twitter, to really scare Tesla investors as if it's somehow their problems as well. It makes it seem like the two are related, even though they have little to do with each other. If anything, Elon Musk has gained tens of millions more followers since we first heard of any of this Twitter acquisition talk. This allows him to reach far more people directly than he's ever been able to before on the platform. And just a few hours ago, he quelled many investor fears by stating that he will make sure Tesla shareholders benefit from Twitter long term. That would certainly be a massive change if what he says comes to fruition, especially if this huge drop in Tesla is all because of Twitter being a net negative. Of course, Elon is ruffling some feathers at Twitter while he makes technical changes and boosts transparency. It would be ideal for the Tesla bears if somehow this could hurt Tesla in the process, which is a great game that the short sellers like to play. And lo and behold, there was a report yesterday coming out of the Wall Street Journal referencing a survey by YouGov, a company that no one has ever heard of or cared about before today, that cited a 1.4% decline in Tesla's approval rating, a non-existent metric, which caused the stock to drop 6% yesterday and another 4% today. Now, I believe that Elon Musk once said something along the lines of that the more the media bashed Tesla, the better their vehicle sales actually performed. While there is a looming economic recession, which could cause a short-term slowdown, we also heard today that Tesla is applying to further expand Giga Berlin. Why would they be doing that if their YouGov approval rating is so low? This demonstrates that clearly it's not Elon Musk who's distracted with Twitter, but rather Tesla investors, be it institutional or some retail, who are distracted by the noise of the short sellers and the media headlines. It reminds me once again of back in 2018-2019, when there was a small window of opportunity for short sellers to pounce, because something big and positive was coming for Tesla, and they needed to get ahead of that and scare people out of the stock to lock in short gains before that big piece of news occurred, such as vehicle deliveries and earnings, which would end up being quite positive. This may actually be a rare time for Tesla, where investors and the media are so distracted with Twitter that finally the drama spotlight can be moved away from Tesla for the time being, allowing them to put their noses to the grindstones and focus on their business. Tesla has proven itself to actually be quite anti-fragile and tends to execute quite well and accelerate when they're under stress and pressure. Moreover, Tesla is ramping up production at Giga Texas and Giga Berlin from an extremely small base to a meaningful amount, enough to move the needle for the entire company. Giga Shanghai appears to have surpassed a run rate of 1 million production units per year, and they've sent people from this extremely productive factory to help further boost production at the US factories. Tesla also just released the semi-truck, which has entered volume production. It's unlikely that Pepsi's long-term business plan factors in Twitter nonsense when a Tesla semi-truck saves them $200,000 within 3 years per truck. The Cybertruck is also on the horizon, and there is a massive wave of tax credits starting in 3 weeks that surprisingly seem to benefit Tesla more than any other automaker in the world. And yet, even with all of these imminent catalysts and more that haven't been mentioned, Tesla is sitting at a multi-year low with a forthcoming expected set of record delivery numbers for the current quarter. The setup is once again strikingly similar to 2019, just before Tesla's unheard-of run-up. Now, Craig Irwin pours cold water on Tesla stock, saying that it shouldn't be worth more than Toyota.
What do you think fair value is for this company right now?
Shouldn't be worth more than Toyota. So I think something well below 100, my price target's 85. I don't believe Tesla's worth more than a company like Toyota. Sells, almost an order of magnitude more vehicles than they do.
We've heard this time and time again. And in a separate interview back in April, he said there's nothing that Tesla has that Toyota couldn't bring to market rapidly. Well, unsurprisingly, making electric vehicles is a lot tougher than people thought, even for Toyota. They had to recall all of their electric vehicles in one of the biggest flops we've seen from the company in recent history. It's not just a recall, but the wheels were falling off their cars, and they had to offer to buy back the vehicles from consumers and then push back their plans by another 2 years, giving Tesla even more time to ramp up and grab market share. Craig also mentions that Toyota sells 10 times more vehicles than Tesla, but in reality, companies are valued based off earnings, not units, and in the most recent quarter, Tesla actually surpassed Toyota's earnings with 10 times fewer sales, meaning that there's still a huge runway ahead. It looks like Craig overestimated the traditional ICE vehicle manufacturers and once again underestimated Tesla.
I've been saying that actually for a while. I'm pretty stubborn. I stick with my thesis for a long time unless I get pushed off it pretty hard.
Craig then goes into ultra FUD mode and starts completely making stuff up.
So the self-driving capability is something that consumes power. If you're going to have level 4 with technology that's on the drawing board today, you're going to consume just as much power for the actual ADAS system itself as you would for the drivetrain. Think about cutting the miles you can drive in half. There's no reason Porsche or Daimler or someone else can't do that.
It's a pretty big stretch to say that the ADAS system would use more power than the drivetrain itself. Craig Irwin's credibility just went from 0 to negative 1.4%. And if this was true, it would still be true for all of the other automakers as well. But we can easily verify that he doesn't know what he's talking about by taking the power usage of Tesla's full self-driving chip, which is 72 watts, and dividing it into the size of the battery, say a common 75 kilowatt-hour battery pack. On a single charge, you'd be able to run Tesla's FSD chip on its own for over 1,000 hours. This is at least about 100 times less power usage than the drivetrain, yet Craig thinks that it will cut the vehicle's range in half. He then cites a whole bunch of 2-year-old issues with Tesla's full self-driving ambitions, but then throws in that there's no reason Porsche or Daimler or Toyota can't do that. But we're already seeing some of these legacy companies start to slowly shut down whatever automated driving projects they were working on. So this is a comedic moment where everything seems to be flipped on its head, drastically confusing shareholders who believe that Tesla is doing extremely well, yet the stock price is reflecting the opposite. It looks like the short sellers still have what it takes to create an extremely pessimistic narrative leading up to Tesla's holiday quarter. So do you think that Tesla bears know something that retail investors still hanging on to Tesla stock don't? And will Tesla's next $75 per share move be $75 lower, down to Craig Irwin's price target, or $75 higher? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.